Welcome back. You're watching The Money Show. And, well, it is the festive season, and this is the time when people go out and buy gold as well. I'm going to be having a conversation now that will perhaps tell you what the outlook for gold is, not necessarily in the coming weeks, but maybe a little bit longer into the future. I'm joined by Somasundaram PR, the Regional Chief Executive Officer, India of the World Gold Council. Thank you so much, as always, Mr. Somasundaram, for taking the time. You've just come out with a report, and this is for the quarter gone by. What are the key highlights? I believe that one of the significant updates was the outflows from ETFs that kind of fouled up the entire demand picture. Wasn't that it?
Actually, it is a very, very small outflow compared with the kind of inflows that we have seen. But in percentage terms, of course, it has had a very, very large influence on the figure. So when we say global demand was down 7%, we are looking at just a 27-ton outflow on ETF against a 270 tons inflow last year, same quarter. So it has actually twisted the ratios. Otherwise, the consumer demand has been pretty good across all markets, jewelry and bars and coins. So that is what we meant when we said that a small outflow has caused the scales to tilt in percentage terms.
Okay, take us through the other highlights. You've said that consumer demand has remained strong, and that seems to be the case even now. Based on anecdotal evidence, there is a store just outside my house, and I see quite a bit of a rush now that it's the festive season. Of course, you're talking about the quarter gone by, but still give us the highlights of that report.
Yes. Globally, as I said, consumer demand is up. All the markets, particularly India, China, Middle East, even US, the jewelry and bars and coins, the physical market, gold, has been pretty strong. 27% jump globally. Technology demand, which is again driven by all the other, laptops and, mobiles, etc. They have done very well, 9% growth. Central banks buying has been a very, very positive feature, 69 tons this quarter. Overall, for the 9 months, 400 tons of purchase by central banks. RBI is a very, very strong buyer in the market. They have added about close to 40 tons this quarter. So overall, the scenario across all the physical elements of gold have been very good. When it comes to the investment gold, as I said, bars and coins, very strong, even in the US. But ETF inflows, there was a very minor outflow of 27 tons, and primarily that is in the US. Coming back to India, obviously very, very low base last year. Against that, we have seen a very, very strong growth, 139 tons, which is a 47% jump. And more than that, we have also seen that imports have far exceeded this demand, so which essentially means that the trade sentiment is very positive for the season.
Mr. Somasundaram, I want to focus on the ETF segment, and I also read in the report, it said that a large part of that outflow is coming from the US, or the weakness in demand for ETF, for gold ETF is coming from the US. What do you reckon that is on account of? Is that on account of the strengthening of the dollar that we've seen over the past months?
Yes. First of all, let me put the figures in context. Last year, 9 months, the inflows in ETFs were one of the highest since the Lehman collapse, the financial crisis of 2008. Last year, in 9 months, there was inflows of 1,000 tons. Against that, this year, there has been a net outflow of 150 tons. So we are talking about figures of that range. So it is not like there have been massive outflows. Having said that, yes, why did the outflows happen and why did the inflows not continue? It's absolutely what you pointed out. One is the stronger dollar, and then the gold price itself has softened. So you will find, therefore, investors certainly, at least a few of them, would look at the price momentum in the short run and would move funds as they think fit. So that would have led to an outflow. So these are the two things, softness in price and a strong dollar. They have definitely contributed to the outflows in the US, but these outflows are not extraordinary. It's not like what we have seen last year in terms of inflows.
Okay. But I do want to understand when you put that and you juxtapose it with the demand for physical gold. There is clear demand, Mr. Somasundaram, for physical gold even in the form of bars, right? So how does one understand the trends that are playing out? Are people buying as investments or are they not? And this, I'm trying to get it from the perspective of the moving parts here. You have the dollar on the one end, you have the yields in the US, and here in India as well, rising inflation. When you talk about all of these things, one would assume that demand for gold should remain strong.
Yes, yeah, as I said, it is very strong if you really look at it and you slice it between what the retail consumers do and what investors, explicitly holding gold for investment reasons, what they do. While ETF is also physical gold, ETF is, it's again bought by people who don't want to hold gold physically in their homes. Whereas bars and coins and jewelry are a different type. So if you really look at it, even in the US, you have seen the bar and coin demand very strong. Overall, globally, there's been an 18% growth in bars and coins. So 33% growth in jewelry. But when it came to the ETFs, there was a marginal outflow. But against a very, very strong inflow last year, same quarter, as I said, it tilted the scales and it appeared as if the percentages are really strongly down, which is not the case. As of now, if you read the market, I think the consumer demand is very strong. Prices are soft, and that's how the gold market operates. When price momentum is very high, consumers tend to wait in the wings, and investors will flow in. And when price momentum is not there, investors move out and consumers come in. That's how it works, and that's exactly what we see at play now.
Okay, I do want to understand the consumer side of things as well. And this obviously is a critical time when we're speaking. We'd spoken a little while back, if I'm not mistaken, last week, when you had that other report that talked about a softness in the price contributing to a significant rise in demand for jewelry, specifically in consumption in India. Do you see that playing out right now? Does the report also bear that out? Is that something that you're factoring in the outlook that you have for jewelry consumption here in India?
Absolutely. 58% has been the growth in September quarter itself, and even the lockdowns were not fully affected. And as I said, the imports have far exceeded this overall demand for this quarter. Imports have risen by 187%. Which means that there is obviously a lot of fabrication inventory building happening in expectation of a good season. So what you would see is a fourth quarter and probably even the first quarter of 2001, barring any significant issues around prices, you will see a very, very strong demand because monsoons have been good, prices are soft for the consumer, all the social occasions are coming back. And therefore, the shops are open. So you will see certainly a very, very sharp spike in demand.
Now, one of the factors, Mr. Somasundaram, that contributed to the price increase in 2020 for gold was the kind of unprecedented demand for ETFs. And I think to a certain extent that high base from last year is what is causing that disparity even as we speak right now. Do you see that as a downside risk or a downward pressure to the prices going forward, assuming that intense buying from ETFs may not really be as prevalent as it was in 2020?
One very important factor to note is, yes, demand does influence price, but in the very short run, demand actually reacts to price. Price is determined by other factors, which are in the futures market, what happens to US interest rates, geopolitics. That's what drives price. Demand reacts to it in the short run. Long run, of course, demand is a very, very significant factor. So price did not rise because people bought ETF. I mean, it was not the sole reason. Obviously, it kept the price going, but ETF inflows were high because the price momentum was strong. And the price momentum was strong because the interest rate scenario was practically the cost of holding gold was nil because of the interest rates. And you had these issues of Corona lockdowns in various economies, which created a lot of uncertainties. So it's very important to note that just because there are outflows in ETFs, it will not lead to a drop in price. As I said, outflows in ETFs happen because investors look at price momentum differently from consumers. Consumers want the softness in price to buy jewelry. Investors wanted a strong momentum up to be able to invest in ETFs. There are two different expectations.
Absolutely. Now, you've also mentioned in the report, and you've spoken about the downside risks, I think globally, and you mentioned geopolitics to a certain extent. This is economic in nature. What is happening in China? As one of the largest consumers of gold, how big a risk is that? And maybe the real estate scenario that is playing out there, how should one sitting in India read what is happening and anticipate what could happen? How much of a downside risk is that?
Well, as I said, even if there is a risk, we at the moment, we can't fathom what it is all about, given the amount of information we have. But clearly, these are risks which are there in the horizon. So we have obviously to take note of that. But even if these risks act out, I think while China is a big consumer, it's still an importer of gold. Okay, it's not exporting gold. So to that extent, obviously, you're not going to have much of an impact on the supply side for the other economies. The good thing is that other economies are growing strongly. Therefore, our exports is also growing. And our own economy is growing strongly. And we have just about a couple of days ago, we have issued the report which said, incomes actually drive the demand very strongly, more than any other factor. And also there is this looming threat of inflation across the globe, which is again a very good thing for gold. So China risks, I don't think in the short run is going to affect the global market. Having said that, this is based on what we have at the moment.
Absolutely. Mr. Somasundaram, as always, it's very insightful speaking to you, and I'm sure our viewers looking at the prices of gold also will have some clarity as to the factors that could affect it going forward. It is the festive season. Here's wishing you and your family and your team a very happy Diwali from all of us here at ET Now. Thank you so much for taking the time.
Thank you very much.
All right, on that note, we're slipping into a short break, but do stay tuned. More on the other side.